What exactly is a portfolio loan and why does it matter? Back in 2008, after the mortgage meltdown, a wave of savvy international buyers, many from Asia, started buying up California real estate. These buyers often had strong incomes and large down payments, but because they weren't U.S. citizens, they couldn't qualify for traditional loans. At JVM Lending, we had to turn many of them away, not because they weren't qualified, but because the loan guidelines we followed were too strict. So, we referred them to a Bay Area bank that offered portfolio loans. A portfolio loan is a mortgage that the lender keeps in-house, meaning the loan isn't sold off to investors, and the lender sets its own rules. The bank literally holds on to the loan documents and services the loan itself. These loans are rare now because almost every mortgage, whether it's a Fannie Mae, Freddie Mac, FHA, VA, or even many jumbo loans, is sold on the secondary market to become part of a mortgage-backed security. That's why lending guidelines are so rigid. When loans are sold to investors, every single file must meet exact standards. It's not about common sense, it's about compliance. So even a buyer with perfect credit, plenty of cash, and a huge down payment can get denied simply because their income doesn't check the right boxes. With portfolio loans, lenders can be more flexible. They can use discretion, and they often maintain a personal relationship with the borrower. But here's the trade-off. If every loan had to stay with the original lender, interest rates would be much higher, and the mortgage market wouldn't have nearly enough capital to meet demand. At JVM Lending, we understand both sides of the coin. We work within traditional lending channels, but we also know when it's time to point clients toward a portfolio loan solution. So if you're running into roadblocks with standard mortgage options, reach out to JVM Lending. We'll help you explore every path and find the one that actually works.